If it wasn't for people like us, they would be adrift without a life raft, right? They would have premiums to make. And again, the death benefit is not what these people at this point in their life want. They want cash. They want as much cash as possible. Their options are multiple. Okay, let's walk through them. They could stop paying the premiums, probably surrender the policy, get nothing for it. They could sell the policy back to the carrier and maybe get 10 cents on the dollar. But actually, then what I'm seeing now in my correspondence with carriers are now required to disclose that life settlements are an option to insureds. And I've seen it in bold print right where insureds would see it, because this is an ethical option where they can get as much money as possible for the policy. And again, without investors like you, it's just they are not getting as much as they could.
Have you ever heard of a life settlement? Well, guess what? Today we have the owner of a life settlement company talking to us about how this product works, how he selects his policies, and why following Warren Buffett is a smart move. You're not going to want to miss this interview. It's very interesting. Coming up. Okay, everybody, I have an amazing guest here today, somebody that you won't hear like outside of this in stock market talks or anything like in, say, annuity talks or anywhere in finance, because there's not a lot of people on this planet who do what this guy does for a job. It's a very, very unique job. So it is a pleasure to have him on here. This is Barry Neal, the CEO of Life Asset, which is a life settlement company. We've been talking about life settlements as an alternative. We talk about being truly diversified. Lately, with what's gone on in the market and the craziness, has a lot of people now finally thinking outside of the box, thinking outside of things like the snugly safe approach of annuities and CDs, because those don't really do too well as far as maybe even outpacing inflation. So the key here is people are looking for something that has no stock market risk and competitive returns. And as I've told people, that's where you got to look at possibly putting money into alternative investments. And one of them that has done fairly well is life settlements. And it's a place, as we always have mentioned here, where Warren Buffett has put a lot of money in there, over $1 billion. And so there's not a lot of people on this planet who actually own life settlement companies. And we have one of them here today. I've known him for a long time. Barry, appreciate you coming on here.
Yeah, thanks for having me on, Ben. And of course, stock market advisors are not going to be telling us about life settlements because they don't like to remind us that stocks have risk. And like you mentioned with this tariffs and this market stuff, stock market performance has not been what people hope for over various time periods.
Right. And that's where you come into the game, because this is essentially you're just, before we make you some genius here, you're good at what you do, but you're really just kind of following the lead of people like Warren Buffett who've been doing this for decades. And now you're able, where you're different is you're not buying and holding. You're buying and then putting portfolios together to offer to the average Joe investor if they qualify. Most of them will need to be credit investors, but give them an opportunity, because these people wouldn't be able to buy policies by themselves, right?
That's right. What we do is make it easier than ever to own other people's death benefit claims. So you don't need to know how to acquire a policy or any of the back end stuff that goes into it. Place an investment, collect people's death benefit claims. It's that simple.
Okay, great. How did you wind up getting into this? I know the story, but I'd love you to share it. I know your father as well. He's somebody that I had worked as a colleague out there doing business with. Mainly, he was kind of insurance-based focused. That's where it's interesting. People kind of jump into the life settlement process, usually from that side, because they like working the side of the street of no stock market risk, which would mean that they're probably out there as a financial advisor or dealing with people with annuities and income. And that's where your father was. But I know he was one of the earlier people to get into this space. And obviously that was something that appealed to you from him. So why don't you explain a little bit just how, over your timeline, how you wound up going from the son of an insurance salesman to then actually owning a life settlement company?
Yeah. My father has a lot of experience in both estate planning and life insurance. You could say I followed in his footsteps.
Right.
Started marketing insurance, annuities, programs that most people have heard of, IULs. And you know this, Ben, but when you have a license and you're selling, you're constantly being solicited for alternative investments. And there was just a lot that I liked about life settlements that you just don't find in other alternative investments. Not that, oil and gas and real estate offerings and things like this don't have their place, but life settlements are really unique. And with things like COVID and stock markets breaking down, I think they've really, come into their own over these past several years.
Okay, great. So explain to people the process of, you obviously go out and work with a team that goes and finds policies. I think people will be interested. I think, when I talk to people about this, they think that you're over or I'm out there knocking on doors trying to find some older lady living in Boca Raton, and trying to get that. It doesn't work that way, right? You actually don't deal with those people up front. You work through vetted legal systems to make sure that those policies are legit. What I think people are misunderstanding is that you don't really have to solicit. You don't solicit. There is a large amount of senior citizens out there that essentially put their policies up for bid. That part of it you don't have to deal with, right? It's really now about selecting the ones that are right for your clients. Walk us through that process.
Yeah, that's right. So there's a lot that goes into both acquiring the policies and packaging our offerings before they become the turnkey product that investors see. Of course, our policy acquisition guy, close business partner of mine, I speak with him regularly. He's looking at maybe 150 policies a month to select just 2 or 3 for us. And it's not like most people think. I mean, we're buying from providers, licensed providers and funds. There's not a lot of these. And typically, most policies that come to market will be on these various providers. And so it's really like an auction process. Think like eBay for life insurance policies, where institutions are bidding on the policies. And so, policies that meet our criteria for things like age, premium schedule, obviously the beneficiaries all need to sign off. We're only talking about permanent policies here. We'd never take a policy that we would not expect to pay out. And, the best policies usually have a life expectancy report ran. If this person seems to be in, worse than average health, or there seems to be extra value add there, these are the policies we're most interested in. So,
Right.
By the time we acquire enough policies, package it into a portfolio, that's usually a few months to get to that point, to the point where you see these policies.
Right. And when you talk about, I'll explain to people too, permanent policies for those who aren't really in the know as far as life insurance, there's kind of 3 basic policies out there, which are either obviously term policies, which Barry here and his team would never buy due to the fact that there's an expiration date on them. Number 2 is whole life, where people are kind of paying up a lot more up front and then getting a guaranteed interest rate where it kind of just runs itself. People aren't going to, the way I equate that is like, it's like paying down your mortgage. It's not something that somebody's going to sell, right? Because they don't have premiums or costs every year. Premiums, a terminology, insurance of the cost of it every year. So really what you're looking at is that kind of vanilla in the middle universal life policy, right? It's going to be permanent, but there is a cost every year for the person on it. And there's not really any cash value. Why would these people, get rid of their policies, and what were they really using these policies for in the first place?
Yeah. So, one of the common scenarios is medicals. Is this person needs to raise cash for medicals or another reason, and they don't care so much about the death benefit claim. They want a living benefit. They want cash while they're alive. And so, ultimately, investors like you are the ones to provide that, creating a win-win scenario. It could be any reason. It could be they can no longer afford the policy. It could be that they don't, God forbid, have the dependents they wanted to take care of
Yes.
when they purchased the policy, or even something like estate tax, sometimes known as death tax, where they
Yes.
bought this policy to take care of their estate taxes when they pass for higher net worth individuals. And due to changes in laws or changes in their situation, they again just no longer need the policy.
Now, let's get to the white elephant in the room, so to speak, or the 300-pound gorilla, or whatever the terminology is, when you explain to people up front what you do, I know, and then for myself, because it is a product that I like to tell people about, the first look is like, you're profiting on people's death. Sure, it's an initial reaction, but the issue here is there's a reason why Warren Buffett puts $1 billion in this space. And I kind of turn on its head. Talk about the compassionate investing aspect here. I mean, I don't think people break it down to that. Like, these people really do not want their policies and the cost anymore, and they need money to take care of themselves at the end of life. Now, if you can, walk them through the studies that you've heard about, like Wharton School, it's something we talk about all the time, and how you really, in a way, are a lifeline to these people to get more money. They're paying you more money than they would if they just cashed in with ABC Insurance Company, right?
Of course. Yeah. So we really are like angels to these people. We're coming in their hour of need. If it wasn't for people like us, they would be adrift without a life raft, right? They would have premiums to make. And again, the death benefit is not what these people at this point in their life want. They want cash. They want as much cash as possible. Their options are multiple. Okay, let's walk through them. They could stop paying the premiums, probably surrender the policy, get nothing for it. They could sell the policy back to the carrier and maybe get 10 cents on the dollar. But actually, then what I'm seeing now in my correspondence with carriers are now required to disclose that life settlements are an option to insureds. And I've seen it in bold print right where insureds would see it, because this is an ethical option where they can get as much money as possible for the policy. And again, without investors like you, it's simply, it's just they are not getting as much as they could. So we're all going to die. I mean, we need to face that reality, and for them to get the best deal they can while they're alive. And then you're rewarded for your patience holding the policy until maturity and collecting the death benefit. I mean, what's morbid about that?
Okay, we cover a lot of content on here, and I'm always asked this important question: where do I start? What is a good first step? Well, if you're looking for a way to diversify your retirement away from market volatility and still get competitive returns, I want you to watch this free on-demand training. In under 30 minutes, I will walk you through the exact strategy that smart and wealthy investors like Warren Buffett have used for decades, and they do it by investing in what's called life settlements. We'll break down how this works, real case studies, and how you can add this market-independent asset class to your portfolio without having to lock it up for 10 to 15 years in some low-performing annuity. You will learn how to build stable, predictable growth and, yes, get true diversification, especially in today's uncertain environment. All you have to do is go to lifeassetllc.com/webinar. Again, that is lifeassetllc.com/webinar, or you can click on the link below here and watch it now. It is completely free, and I think you'll find it will be a game changer on how you think about investing for your retirement. Okay, now let's get back to the show.
Exactly. The adage I always tell people is it's usually a husband and wife when they sit with me, and when I do get that morbid angle, it's usually from the wife. I'm no misogyny here. It just is kind of the man's kind of like, oh, what's the rate of return? And her angle's more like, oh my God, like, I don't know about this. And I always say to her, okay, so you have a problem with this because this person wants to sell it. They don't want it. They need the money now. And that money's going to go to you. And they're like, well, yeah, but the fact that they die and I make money. And then I always say, well, do you have life insurance on your husband? And they say, yes. I say, okay, well, then we need to make a distinction here. You absolutely have no problem making money on the person that you've been with for 20, 30, 40 years and is the love of your life dying. But if it's somebody who you don't even know and they don't even care that you own it and you've given them money, and usually the light bulb there goes off and they go, okay, I see your point. So yeah, it's just that front angle, and it's understood like, oh my God, this is kind of morbid, but it's how life insurance works, right?
Right. Yeah, and before you ask, these insureds, you've had the policies a few years. Hey, why do we have to wait? No, I will not put you in touch with the insured. You cannot have a
Oh
hard
yeah.
talk
No,
with
no, no.
them.
I
You
know.
cannot send
Yeah.
them a carton of
Silliness.
cigarettes around Christmas time. No Groupon ticket for motorcycle ride. These people are going to
Yeah.
going to live their life, and
Yes. Yeah.
again, we
But
help
let's
them so we can.
but let's talk about that. As an investor, what is disclosed, Barry? What is disclosed is if I came in today and said, "Hey, I want to put 100 grand in this." What can you give me today as just like, let's put it in the form of like real estate. If I want to go buy a house, I can get an appraisal, I can get home inspection, I can run different scenarios. I can look at the Zillows of the world to get an estimation. Talk about that. Talk about the life expectancy reports and all that on what information people get up front to know what they're actually buying.
Yeah, and just like you wouldn't buy any other asset sight unseen, before we're acquiring these policies, we're presented with a life expectancy report on each policy. This is done by a licensed third-party company. Okay, that life expectancy
And doctors, right? They're doctors, correct?
Oh yeah. Yeah,
Okay.
this is a licensed third-party company comprised of doctors and actuaries. So every report is signed off by a medical doctor that has reviewed that insured's records. Okay, and
Right.
by records, I mean extensive medical records. I'm talking about a HIPAA released form, and the summary of this life expectancy estimate is disclosed to you as the investor.
Right.
And it includes things not only like their height, weight, sex, but also, social and family history. And you'll see these insureds typically are in worse than average health. Why? Because that's going to create a higher value policy. That's the one we're most interested in.
Right. And as you mentioned before, you guys might get 1 or 2 or 3 out of 150 seen. And what you're really looking for there is exactly that. There is no need for you to go start buying policies on people who are going to live the average life expectancy. There is a ton out there where you can it's like seeing that person at the grocery store. You can look through all the apples to find that perfect apple to fit what you want and what you need, and what's best for your client base, right? You're not in a position now where you're like, oh my God, I got to take somebody like Jack LaLanne. These are people, and I've seen the reports over and over and over. These are people who, as I've explained, they're not dying from brain cancer tomorrow, but they have a litany of issues that leads you to believe that they're not going to live beyond the normal life expectancy and probably half of that, right?
Yeah. And, when we were starting my life settlement companies years ago, I got into it around 2016, starting our first offerings in 2018. One thing we started doing differently was the portfolio structure. So the portfolio structure means not only do we look at policies that are good on their own, they fit well with other policies to create a product that works for you. So we're talking about, it might be good to have a longer life expectancy. It might be good to have a shorter life expectancy because it depends how much spread we can build into that product, into that policy for you. We can have policies that are more expensive, ones that are in worse health. We can actually make it work where we have policies that aren't in much worse health than average, but they're cheaper policies. And so we can bundle these different types of policies together to create, the best product over the course of the investment.
Analogy comes to mind for anyone who plays Monopoly. You're okay with buying and putting up some hotels on Baltic and then getting a place on Park Avenue, and it's the blend, right? Because the Park Avenue is going to cost you a lot, and if somebody lands there, it's a steep price. But you also want to buy some of those Baltic Avenues, and then you have your portfolio blend. If somebody understands, am I right about that? It's kind of the idea is you got to buy, or in real estate, you got to buy some houses in the lesser expensive neighborhoods and buy some in the nicer neighborhoods, and it's a blend, right?
That's right. And if we can, we're getting our policies in a row on adjacent squares so that the client is really, benefiting in a kind of a synergistic way.
Let's talk about returns, okay? You and I just talked before we got on here is talk about how that works, what the process is. I know you guys just had a maturity just a couple months ago. Walk us through what the numbers were on that, and is that kind of what you see? And then what is the process for people getting paid? I also remind them if it's an IRA, because you do, what percentage of cases are investors putting in IRA money? 70%-ish, somewhere in there, about $7 out of $10. company?
Yeah, good question. Questions. I believe about 2/3 of our business is IRA. So if you're interested in IRA, again, we help with all of that paperwork. It's still a turnkey product, even if you're using 401k or other IRA funds. We have had payouts, both actually recently and pending. So, just a couple of examples. We have one pending right now. It's about 773,000. I expect it to pay in a couple months. That life expectancy, if you're curious, was about 35 months. The insured died right around that time, believe it or not. So it turned out to be very accurate. It does take a few months to file the death benefit claim. And I think once it's all said and done, we'll be paying out about 38, 39 months. And clients will have realized about a 10% APR. And then our last payout, $1 million payout, was about an 8-year life expectancy, paid out in about 6. Clients are making about 12.5% APR on that one.
We talk about competitive returns, decent returns. Let's review here. You've had literally one payout just a couple months ago. You've got another one coming in back to back. They are right in that ballpark. About one was about a 3-year life expectancy. They paid out right about that, went just a little long, which then resulted in a 10% APR. Another one, the person passed away 2 years earlier, which then got you into a higher level, 12% APR, which, by the way, which studies have shown for the ultra wealthy, like the Warren Buffetts, they are usually in that pocket of what you're talking about. So the bottom line is, you can't guarantee these types of returns, but you have 2 cases that just happened back to back here that show it pretty much on those cases are doing what it needs for the client base. And the reason the client base came to you was because they don't want to make the 3, 4, 5, 6% returns with annuities that they might already have. But at the same time, they want to see a return that is decent enough that they don't just have to take extra risk in the market with all their money, right? So that really does the blend there. You just gave us the blend, right? They're making a decent return and not one of these dollars was ever in the market, right?
Yeah, it goes back to why I liked life settlements in the beginning. Is for its risk reward profile. You know how much death benefit you're going to realize over the course of the investment. Sure, you don't know exactly when, and as you're catching on, your APR can vary depending on when the insured's passed away. We've had some policies pay out extraordinarily quickly, in even 1 and 2 years or less, and clients make a triple-digit APR. On the other hand, we have had policies go long, clients making, 6, 7% APR. But that's why you have...
And Barry, just so we understand, because you're talking about the wins, there are going to be cases where you have those that do just stellar. The law of averages tells you that you're going to have cases where people make very, very little, but that's why it's so key to have it in that portfolio of 5, right? Because you have some wins, you have some ones that are not doing so well, and then the blend gives you that return that people want to see, correct?
Yeah, life asset, current offering, 6 policies. With the 6 policies, if you have some come in early, some go long, we want to ultimately have a competitive product over the course of the investment. Yes, we don't have a crystal ball. We can't time exactly when any one person is going to pass away. But that's why, we recommend investing in several life settlements. And that's why we built our portfolios the way we have. Yeah.
Right. Okay, great. Well, everybody, we will have Barry's information and his company, Life Assets information, in the notes, and we will be bringing him back fairly soon. Barry, go ahead and mark that on your calendar. When you get that payout, we want to bring you back on so we can once again review how this works. At some point, we probably will try to see if we can get one of your clients to come on as well, just to have them explain why they would get into it. But I'm sure after those 2 payouts, they'll be more than happy to tell everybody why they got into this, because it's worked out, especially during this time with the market being so shaky. Your clients are going to be, I'm sure, very happy if you just paid them last couple months and now you're paying them again. And both of these returns are in double digits while the market has just been taking a big whiff for the last few months. I'm sure they're going to be very, very pleased.
Yeah, no doubt, Ben. I'd love to have a client come on with you.
Okay, great. Well, Barry, thank you so much for your time. It's been very interesting, very helpful, very insightful. I'm sure people love to hear about this. It's a very, very unique aspect on investing, as I told people, and a great way to be truly diversified. So we thank you for your time.
All right. Thanks, Ben.